Starting with the Monetary Policy Committee, as you know, our main focus at the central bank is on inflation, which determines the stability of the economy. And so any action we take is to manage inflation. And as you see from this graph, inflation in the third quarter has slightly increased from where we were in the last almost 3 quarters to an average of 2.4. Again, as you see, it's moving into the band that we normally track behavior of the inflation. So we expect this to continue. As you saw in October, we had inflation at 4.4%. And we expect this upward trend to continue based on building on the base of very low inflation we had since mid last year. And so, but we expect it to be around the medium term benchmark we monitor at the central bank of 5%. So that's the main message we have. We see or we have on inflation. It's still stable and still below our benchmark, and we expect this to remain around the benchmark over the next medium term, at least for the next 1 year. So let's move on to the next item. Now this is on credit. Whatever we do, again, as a central bank, our decisions we take is reflected in how the financial markets behave and how the credit to the private sector behave. When we say we are moving into an accommodative monetary policy, our main objective is to see credit to the private sector increasing. And as you know, we've been accommodative for almost more than 1 year now. And what this graph shows us is that we saw credit to the private sector increasing, and the new authorized loans really increased sharply by 41%, as you see on the graph on the left-hand side, compared to 0.3% we had recorded in the first 9 months of last year. So this was mainly driven by the good economic conditions that we see, again, as you will see in the next slide. But also, again, as a central bank, we remained accommodative and with the intention to see this behavior in the credit to the private sector. So both the new authorized loans and the outstanding credit to the private sector had big increases over the first 9 months of this year, and we're happy with that because it's in line with the objectives of the monetary policy in the first 9 months of this year. Then we link the growth in the credit to the interest rate itself. Normally, when we take a decision as a central bank, our main expectation is to see the money market interest rates follow the decisions of the central bank. And as you see from mid-2017, money market rates have been moving in the same direction as the central bank policy rate, which gives us indication that we are improving on how we can influence the money market interest rates, which is our main objective as a central bank. And at the end of the day, we want to influence, of course, the interest rates on lending and deposits within the banking industry, though this takes time and that is expected. But the good thing, again, as you see on the graph on the right-hand side of the screen, we see the lending interest rates going down, though it has been slower than the money market rates you see on the right side. But the good thing is that we see this moving from around 17.3% in 2017, and today where we are at 16.47 by end of September. So we see that also in response to, one, the good economic condition that we've seen over the last 3 years, but also the continued accommodative monetary policy, as as you know, we've moved from around 7% and now we're at 5%. So that has really influenced the movements in the interest rates. So we see this on the lending rates, we see it on the deposit rates, we also see it on the capital market rates, though we didn't plot that here, but at least the rates have been moving in the same direction as the monetary policy decisions. And this also has an impact on the level of borrowing we've seen in the market. And now on this slide, we talk of the external sector, and from the central bank point of view, we see this as in relation to the foreign exchange market, part of our day-to-day business. In the first 9 months, we see our exports growing by 3.9%. We mainly saw negative growth in the traditional exports, but the good thing to note is that despite the negative growth in traditional exports, overall performance of our exports is positive. This indicates diversification we are witnessing in the export base of our country. So with a negative 17.5 growth in the traditional export, that's coffee, tea, and minerals. This was really normally without improvement in the non-traditional exports and re-export, we would have expected a negative growth overall. But we saw the re-exports growing by 22.6% and the non-traditional exports growing by 12%. So this was able to enable us to register positive growth in the exports overall. But we saw bigger growth in imports, and with imports having a bigger base than even the exports. So this bigger growth in imports increased the deficit. So we saw the trade deficit widening by 24.2%. But again, as I had indicated earlier in the monetary policy and financial stability statement, the good thing to note is that this big increase in imports is really driven by capital goods and intermediate goods, which is linked to investments in the economy in general. So that is the one that is putting pressure on the export bill. And so because of these developments, high import growth compared to the export growth, we see depreciation. We see the FAR depreciating against the dollar because there is much bigger demand compared to the receipts we get. So today we are at 4.2%. And we expect by the end of this year to be at around 4.8% compared to 4% we had for 2018. And on the market, or on the economic performance in general, while this is followed day to day by the Ministry of Finance, but we also have interest in this because this impacts on our monetary policy, impacts on our main business as a central bank anyway, as part of the economic managers of this country. So we see positive story here. I think this was already communicated to you during the press conference we had with the minister and IMF 2 days ago. But the good thing, I think this first graph that is projected here with the 10.3% in the first half of this year, that you've already seen that story. I think our story here is on the second graph that shows what we monitor as a central bank, which is the Composite index of economic activity. So these are frequent economic numbers we track to see how the economy is performing. And as you see, the graph plotted there, it moves in the same direction with the final actual numbers. So though we don't have the numbers for the third quarter, that will be given by the Institute of Statistics. But what we see from the frequent numbers, we expect this to still remain strong, the performance of the economy remain strong in the third quarter of this year when we look at our composite index for economic activities. So that's the message we can give, and that is also linked to what we see in the lending to the private sector. It's linked to what we see in inflation, with the inflation slightly peaking because of linked also to different economic activities, and domestic demand picking up. So that's the story we have from this slide. Then normally all this is put into context with what is happening on the global market. And as you've heard again, and as you heard from the IMF, we expect economic growth for the global economy to slow down in 2019 compared to what we had last year. Last year is to grow at 3.6, and this is expected to slow down to 3%, but also peak up in 2020. So normally we look at this, the main impact, or the channel that this impacts us, is on our external trade. So this negatively impacted on the commodity prices. That's why we see a negative growth in our export earnings, in our traditional export earnings. And so we expect this to be probably reversed during the course of next year, because we expect the economy to perform better next year. But we also gain positively from the slowdown, or from the negative growth on the prices of petroleum products, because we are a net importer of oil. So there's a mixed story here. But I think what we see in the 2019 was really this hit us on our traditional exports. So as to conclude on the monetary policy discussions, based on what we've observed in the last slides, inflation remaining low and stable, and this is expected to continue in the next 1 year, and we expect inflation to average 2.3 in 2019 and around 5% next year. So the Monetary Policy Committee decided to maintain the central bank policy rate at 5%, to continue supporting the lending to the economy and the improvement we've already seen in the aggregate demand in this economy. But again, we remain engaged as a monetary policy. If anything unusual happens during the course of this term, we're always ready to sit and take any necessary action. So that is the summary of what we came out of the Monetary Policy Committee. And the next slides talk about the Financial Stability Committee. And that can be summarized in mainly 3 slides. This first slide gives the structure and performance of the financial sector in general. I don't have to go back into the numbers of how many banks or institutions we have. I think this is common knowledge, but I think what's important to note here is banks remain the biggest subsector of the financial sector, at 65% of the total assets of the financial sector. And we see linked to the good performance in credit and the other aspects of their business, we saw their assets growing by 13% when you compare to where we were September last year to September this year. We saw the same growth across all the subsectors of the financial sector. All their assets had positive growth. So this, as you see down, the average or the overall combined growth of the sector assets was 13.9%, increasing to 5 trillion. But our main business as a central bank, as a regulator, is on stability indicators that we follow, and that comes to the next slide. So these are soundness indicators that we track and we enforce from time to time as the regulator of the financial sector. On the banking side, we look at the capital adequacy, how well capitalized the banks are, and we normally have a minimum that any institution wouldn't go below at 15% of their capital adequacy ratio. So we not see that this remains strong at 23.7% for the entire industry, and we can say that none of the banks is below the required minimum of 15%. The other positive thing to note is on the quality of their loans that has improved when we look at the non-performing loans going down to 5.3 by end of September compared to 7.2 where they were. Again, as we said last time in the Monetary Policy and Financial Stability Statement, while this is linked to a good performance in the economy, increase in credit, improved capacity of the borrowers to service their loans, our concern here has been the written off loans, because it contributed to the improvement in the non-performing loans we see here. So that's something we keep engaging with the banks and the other stakeholders we see, the other stakeholder that we work together to support the good performance of the banking industry. Again, what we note as a central bank, we see improved provisions. At least the level of provisions gives us comfort that we won't see any these NPLs impacting on the stability of the banks. Again, we see good profitability within the banking industry, increasing from 37 billion to 51 billion. The liquidity ratio is one thing that we also follow. How liquid are banks? If their customers need their money, how are they able to service or to meet the obligations? And we see healthy liquidity numbers within the banking industry. We have the same story in the microfinance institutions, strong capital base at 35.3 of their capital adequacy ratio. Their non-performing loans also reducing from 6.8 to 6.1, and improved profitability from 5.7 billion to 9.9 billion. So this is linked to the good performance, meant a good performance in the economy, as we said, and especially in agriculture, because most of the microfinance institutions, especially the SACCOs, deal with the farmers more than the bigger financial institutions. But also we saw good impact on the initiatives taken by the government from the last Muchichirano, where government put up a committee to follow up people that were not paying back their loans to the Umrenje SACCOs. So that also had a positive impact on reducing the NPLs, but also on improving the profitability of the SACCOs. I think the last slide is on the soundness indicators on the insurance sector. And this, we are mainly focusing on the private insurance sector because the public insurance companies are very good numbers, so it's not giving us any big concern, but we've been following up. Mainly our concern is to ensure stability in the private insurance sector. Gone to 6.1 billion today from 4.3 billion they had in September last year. Our concern still remains on the yellow bar that goes down. That means they are still making underwriting losses. So our engagement with them is to see how they, one, do proper pricing of their products and manage any inefficiencies within their business. I think that's where we still have concern on the profitability of insurance sector in their main or their core business of underwriting risks. The other side, we showed the solvency of the private insurers, and I think from September 17, they've remained strongly solvent, and we don't have any big challenge here. So I think those were the slides we had to summarize the discussions of the two committees. We'll be happy to receive questions from yourselves.